Today and spend a little bit of Saturday with me. So I really like these Saturday live events, make them as interactive as possible so we can kind of kick back. Markets are closed, talk to markets, go through things that are coming up. But today we're going to focus in on some really what I love these two strategies we're going to talk about. They're two of my favorites. So these are kind of best, what I regard as high reward, low risk option strategies for uncertain markets. So these are two strategies we're going to cover today, the butterfly and the long condor. So kick back, grab your notepad, your tea or whatever your beverage is, and let's go. And feel free to ask questions now. If I miss one of your questions, they tend to scroll off on GoToWebinar, so just put it back up there again, and I'll make sure I try to get the answer to you or go through what you're inquiring about. So that being said, let us get started. So we're going to talk about two really great strategies that you can use for any type of market environment, but really great for when we get high uncertainty, because we can really lower the risk using these two strategies. But before we get started, I guess I'll give a little bit background on myself. I've been actively trading now for over 40 years, and that's a aha to imagine that. But started trading options about 30 years ago, back in 1987. So my journey on the trading side, though, started out on the oil side back in the 80s with a company called Coastal Corporation, which was a big major refining company, and we had a lot of refineries that we would supply. So they'd actually had a training program to teach you how to trade oil, to accumulate oil from various parts of the world, trade it around, get it into your refinery. So that was my start, and it was really exciting journey from there. I went on to a company called Transworld Oil, which at the time was the largest oil trading company in the world. So it was Transworld, Mark Rich, and Fibro, and spent about 17 years there at Transworld, and ran the international trading desk or trading group out of Bermuda for 10 years. So that's where I really got into the options side. We started trading options on cargoes of crude oil back in 1987, and just never looked back. So that's where I got my experience and first taste of options, and I've never wanted to do anything else since having that opportunity. So that being said, let us get started and talk about the butterfly. So the following presentation is purely for educational purposes. Any stocks, options, or futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So to me, the secret to trading profits really comes down to three things: direction, timing, and then options for what we call opportunistic risk management. Now, I've been trading, like I said, for over 30 years, and found that the most valuable go-to option strategies that can literally help any trader more than any other type of strategy, and especially during times of extreme market uncertainty, are the butterfly and the long condors. So they're kind of what I call my trading secret weapon. Now, the huge advantage that these two strategies offer is their unique option framework that is designed to take advantage of time decay, theta, and volatility, the two main option pricing components, to stack the trading odds in your favor. And they can be used in any type of market environment. But when we get into really higher uncertainty type of markets that could be very volatile with a lot of headline risk, things like that, these are two strategies that we'll go to and look at very long and hard, because what they can do is really lower your risk. So if you just know when and how to use them, there can be really a great one to add to your trading arsenal. Now, because they're going to be structured to require only a small amount of your hard-earned capital, your trading returns can be very explosive. So kind of like lightning in a bottle. So the thing is, we get the leverage from the butterfly and the condor, but we can keep our risk super low by the structure, and that's the thing that's really great. And so once you get this and you get some explosive moves, you kind of want to bottle it up like it is a trade that you want to do over and over and over. So kind of like lightning in a bottle. Now, when we look at the butterfly and long condors, they're very dynamic, and they can be traded for a variety of different reasons, with different goals in mind. So in other words, once you learn how to trade the butterfly or the long condor, you're going to be covered for both your offense and your defense. So, you can really, get your defense going by using these as a hedging technique, and they're great because they offer great leverage on really defined low risk. Now, what we can also do is they can work no matter what the market cycle is. So we could be in an up, down, or sideways market environment. They can be working when you know, to give yourself income from stocks that are going nowhere, or really help you to eliminate the stress of having to be perfect on a stock's direction or the overall market. Also, it helps to eliminate the time decay expense that it encountered from decaying long options. So that's kind of a real obsession with me and option traders, is that time decay. So we can always get a positive theta type trade set up when we use the butterfly and long condor. Now, another thing that will really help to take the unsettling guesswork out of your trading. So a lot of times you're quite unsure, about if you're going to get your targets hit up or down. But with these two strategies, we can really lower that risk to make it more tolerable, if we are wrong, but offering you this big return, for that risk you're taking. They can be structured for very low cost, low capital at risk, and these can offer you returns of 10 to 1 or higher. So I'll show you a couple examples of where you can get these really, high levered returns, and again, on low defined risk. So your risk exposure is very, very small. Now, when we look at the butterfly and condor, they can also be used for hedging. So, you're going to mess trades up, and this is what I found to be a really fast, low-cost way to cover your what pronto when a position starts to move against you. So I've literally found no other hedging strategy that comes close to incorporating, using the butterfly defense or long condor defense in your trades. So by constructing either a butterfly or long condor around a strike price that's under pressure from another core trade, such as if you're doing credit spreads or debit spreads, is the best way I've found to immediately neutralize and also lower that risk. So, if you've ever done credit spreads, you've probably got an idea that, you can have a really good success rate going, but then all of a sudden, like, for example, last week, man, if you've been, I was thinking of one example, if you'd taken advantage and let's say you were selling, call credit spreads or something on NVIDIA, thinking, man, this premium's so big and, it can't go any higher, and then you just get, exploded through your short strike. And, those kind of things can really mess up your trading experience when you have credit spreads and it goes to your short strike. But with the butterfly defense, we can actually hedge that out, neutralize and lower that risk. So that's one thing that you can do with it. And here's like a little comment from Pam, one of my members, said, wish I'd known how to do this hedging before I lost so much money on credit spreads. So that's one thing that we can do. We can use either butterfly defense or condor defense on credit spreads or debit spreads to adjust the risk of that specific trade. Now, when we look at the butterfly, they're a very kind of a simplistic trade setup, and they're based on vertical spreads, debit spreads, and credit spreads. So in this example, this would be like a long call debit spread. So you're long a call, short a call, and in this example, you can see you'd be long that call, the 10-10 call here. This is like the NASDAQ 100. So long that call and then short against it, the 10-20. So you've got that spread of $10, which would be $1,000 per spread on an option contract. So spread width is $1,000. Your risk is the debit paid of $300. So your potential profit is the difference of $700. So a really nice return. But if we wanted to reduce that risk further, we could easily do it by offsetting that risk using a butterfly and setting a vertical credit spread against it. So we can just come out and add a credit spread to it, and we can then create the butterfly. So now we add a bear call credit spread. We sell a call, buy a call here, and we're selling that short strike to 10-20 and then buying the 10-30 to cap our risk. So again, $1,000 wide spread width, but the credit we receive here is only $200. So that's the kind of the negative with the credit spread. So we're risking, more than potentially what we can make. So our max profit would be that credit received, and the potential risk would be $800. So we're risking $800 to make two. So that's a negative positive risk ratio. So, but when we combine those two together, we've just created a balanced butterfly. So then in that next kind of permutation of it, we've now reduced our risk down to 100. So, we've got that combination of those two spreads, the call spread, the credit spread, and now we've got the butterfly. So we went from a $300 risk. Now we've dropped that down to 100 as our max risk. And we've got a potential for a huge potential profit here if we go out at the top of the tent. We call that the tent. So again, if we had a $1,000 wide spread, now our risk is reduced to 100. If we nail it right there, that's potential for $900. But if we get anywhere in between, we still have a really good return. But look at the return. This would be like a 900% return. So that's where you get the really great benefit from, whenever you're trading market uncertainty, and the markets are always uncertain. We never know for sure, right? So this is a really great way to fall back, trade, reduce your stress, reduce your risk, and go from there. Let me see if I can get rid of this drawing tool. So the other part is what we call the long condor. So it's very similar to the butterfly, but what we're doing here is we're widening out the profit zone. Okay, so we can do these type trades with calls or puts depending on if we're going up or down. But you can see here what we're doing is very similar to the butterfly, but we're widening out our profit zone. So we're long a call debit spread or something, but instead of selling the credit spread here, we're going to widen out that profit zone. We're going to widen out that credit spread further out. And so then we still have that hedge position with the large potential profit, but a bigger zone. And this will also, these two strategies will always give you a positive theta on the spread. So you're not going to be losing money if the markets are churning. You're going to have a positive theta. So you're always going to be gaining and not losing on your spread. So can everybody hear me okay? If you're having trouble there, Steve, go out, come back in. So the core concepts that make the butterfly long condor, dynamic, we'll go through just kind of the basics of what really make these a dynamic spread. So when we look at options in general, but especially these types of spreads, the most important option factor for your profit generation really comes down to understanding option pricing and how it works, and the concept then of that time decay or theta and the effect that it has on the price of the option. So let's take a look at this kind of core concept to kind of get our feet back grounded on what makes these kind of things really work. So when we look at the theta, what it does is tells us how much your option price will go down over time. So that's the rate of your time decay of your stock option. And by expiration, the theta goes to zero. So when we're doing these types of spreads, we can get it where we're kind of a theta positive, where it's not going to affect the outcome of the spread just based on time decay. So it's going to be actually structured to go into our favor. So we call that a positive theta. So if you did a SPX end of the day, would you buy, let's say someone trying to read your question, if you held a 4,200, 4,205 call credit spread on SPX expiring at the end of the day, at what price of the SPX would you buy a 41.95, 4,200? Well, a couple things would depend on it. It would depend on how far to expiration, and what the main thing is you don't want to ever let it get through your short strike. So if you had a 4,200, 4,205 credit spread, the first thing is make sure if you're going to hedge it and adjust it, make sure you do it before you get to that short strike of 4,200. So I typically would look 2 to 3 strikes before. So there are a lot of different things you look at, but that's kind of the basic kind of first step. So what we want to do is on these take advantage of this positive theta. So here's an example just of how the basic spread would work. So in this case, we're looking at a put butterfly. We're looking for the market to kind of move lower. And so the other great thing with the butterflies, we can make these very short duration, and we can make them structured for small moves or big moves, just depending on the butterfly spread width. But in this example, we're just looking for a small move down. So just to show you how the math works. So, the market XYZ is trading at 45. We're just looking for a move down to 43. So we can actually do these butterflies for 1 day at expiration, something like that, or maybe 2 weeks out is about as far as I tend to like to go. Now, in this example, let's say we buy that June 44 put, we paid $2.38 for that, so that's the debit cost, and then we're selling against it the 43. So we've got just a dollar wide spread there, and we're bringing in $1.67. Then we're adding another. This would be like a full put credit spread. We're selling another 43, buying the 42 below it. So we've just created a really narrowing butterfly here, and our total risk then is the debit cost of 238, $1.06, less the credit we received on selling those two strikes against, or that body against it. And this is what we call the body of the butterfly. That's your short strikes, okay? So we're long here a put, short a put, short a put, long a put. So now we've created this butterfly, and the spread width is $1 wide, so $10 wide. So here's our cost of the trade less the credit. So this trade spread would cost $10 per spread if you did one butterfly trade. So very, very low risk. Now, in your potential profit, you just look at your middle strike and your lower strikes. It's $1 spread less the cost of the trade, your risk there of 10 cents or $10, and that's going to give you the potential profit. So here we get 43 minus 42 less the cost of the trade. In this example, 10 cents or 10 bucks. So 90 cents potential profit times 100. So potentially you can make $90 on your risk of 10, which would be a 900% return, or 9 to 1. So that's kind of an example of how narrow and how reduced the risk you can get, but there's still the potential for the big return on that lowered risk. The other thing with the butterfly and the condor, we can leg in, leg out, so they present a great opportunity to hedge. So we can start out with a debit spread or start out with a credit spread and then convert and make into a butterfly or condor. So with lots of flexibility to the spread. So the next thing is then, well, how do you choose the best butterfly or long condor strategy for your specific trading goals? Now, everybody's going to have different account size and different times of day that you can trade. Maybe you're more passive, maybe more aggressive. But one major goal, in my opinion, for every trader should be to look to select trades based on what's going to provide you the most consistent positive returns with low defined risk, and not always the greatest return. So I always look at the risk first, and then back into the potential reward on that risk. And I always kind of make the analogy of in trading, look like you're playing it for singles and doubles, and then occasionally you get that big home run. So you want to be very consistent and just kind of be consistent with your trades, hitting those singles, doubles, and occasionally you're going to turn one into a huge winner that can really get your equity curve just kind of a slow, gradual move up versus a lot of volatility in your equity curve. And one of the best ways then to achieve this kind of results is to be aware of the different option strategies out there that are available to you, then understand how they work, and then select the one that's going to be best suited for the market environment you're trading in and your specific goals. So, John may be trading with a $100,000 account, and Sarah's got 10,000 or 5,000. So it's going to make a difference as far as your risk reward that you're looking at. But the one thing with the butterfly and the condor is you can do it with any size account. You can do it, one lot, or you can do it with thousands of contracts. I mean, I set up a brokerage group, over the counter crude oil, and we did. I remember one spread that we did for a hedge fund. They did I think it was 10,000 contract butterfly on oil, futures kind of spread. So we did that over the counter to get it done. But that's the dynamic of it. You can do it with one contract or 10,000 contracts. So it's great for the small trader. We can get in and out actually a lot easier and faster than the big guys. So that's another really good benefit. Now, when we look at the butterfly strategies, there's what I call the butterfly family. So there's a number of different variations, but the thing that they have in common is you're selling time and volatility by putting these spreads together. So we have, the variations of butterflies. So we could do a long call or put butterfly. We can do what we call a broken wing or skip strike butterfly using calls or puts. We can do a ninja unbalanced ratio butterfly. We can do the iron butterfly, And then we've got kind of the other side of it, the hedging defense, which is a great thing to use for, hedging core trades. So we can leg into a butterfly hedging a credit spread or a debit spread. We can make ratio, butterflies to reduce the risk even more. So a lot of flexibility. And then we've got what I kind of call the cousin to it, the long condor spread, which is similar to the butterfly, but again, expanding that profit zone. So we're going to go through, I'll show you a number of different examples so you can get a better idea of actually how these can work and benefit your trading portfolio. So let's take a review and go through a number of different strategies. Okay, just checking the questions. All right, so let's take a look. So first we're going to look at a bunch of different butterflies and go through some examples. Now these examples are trades that, examples from our trading room or alert service that I have. So the first one, let's take a look at just a narrow wing butterfly. So this is going to be like a spread width of $10 or $100 per spread. So this is super, super low risk. And literally you can do these types of low risk trades if you wanted to. So this is one that was set up on a SPY, and the ETFs are fantastic. SPY, QQQ, Russell will do a lot of different, trade strategies using those ETFs, and also the index options at SPX. So the great thing with these types of ETFs is that they've got the option expiration. You've got a number of different weekly option expiration days, so we can really take advantage of that short duration timeframes if we want to. So this is one on SPY, and so it was trading at 267, and we're just looking for an upside move to about 273, 274. So I like to use Fibonacci for what we call target analysis. So, here's kind of swing high to low, and then we had this 618 retracement area right here. And at this example, it was trading at 267. So it's trading right in here. And we were looking just for a targeted move up here. So there's a lot of, I also look at option activity and fib levels, and then other, support resistance levels could be moving averages or what we call price option or price action support resistance. So really good target here to about 273. So did a low, super low risk butterfly using a $10 wide spread. So in this example, you'll see how low risk this could be if you wanted it to be. So this trade, we were targeting that 273 based on the fib levels. And so we did the 272 long call, short the 273, and then short that again along the 274. So very narrow butterfly spread width. Then you can see $1 wide or 10. So that's $100, and the cost of the trade was 10 cents debit or $10 per option contract. So theoretically, if you nailed it perfect right there, this would be $90 a spread. Now you're never going to hit it exactly to the penny, but you can get pretty close. But that's if you did hit it to the penny. So in this situation, that would be a 900% return, or you're making $9 and you're risking 1 to make 9. So that's what's a positive risk ratio. Versus if you do just credit spreads, it's going to be the other way around. So here 2 days later, this was up $70 per spread. That's a 700% return. So you can see your max potential profit 90, your risk there is 10. But if you go out anywhere in between that spread, you still have a potential for a big return on that lowered risk. So here's what it looked like on the risk profile going out. It was going out on the 16th. It was trading at 273, very, very close, 273.08 right here. And so it was right there. So this was went from 10 cents to 80 cents, or $10 to $80, and that's your profit of 70. And on that risk of 10, that's a 700% return. So you can see, a lot of times you're thinking, and you might tell a buddy, hey, I just made 700% return. They might think, sure, Charlie. But this is literally, what you can actually do with the butterfly. Now, of all the different option spreads that are out there, the butterfly will give you the largest return on capital at risk of any of the different spreads. So I'll show you an example of one that was over 1,000% in a few minutes. But the great advantage of it, again, is we're taking advantage of time decay volatility collapse, and a high potential return on your capital at risk. So that's an example of a very narrow wing butterfly. So you can, adjust your risk based on the option, based on the butterfly, the wingspan. Let me back up here again just to kind of illustrate that. So we can actually adjust our risk based on the wingspan of the butterfly. So for example, a good analogy, if you're trying to catch a butterfly, it's going to be much easier to use a really large butterfly net than a small butterfly net. So we can then adjust our profit zone with the butterfly by making, if we really want to reduce our risk, we can make it very, very narrow. But if we want to make a bigger profit zone to capture that butterfly profit, we can widen the spreads out. So we've got a lot of flexibility there, and then we can add additional layers or legs to it to add more defense. So we can make these ratio butterflies, broken wing butterflies, all kinds of different combinations. We've got a lot of flexibility. So the next one, and this is, typically we'll go with more kind of a wide wing butterfly spreads, and that's because they're going to give you a wider zone of profit. The wider the zone you have, that you're able to participate and moves up before getting right to the expiration date. So when you do a narrow wing butterfly, you're pretty much limited to waiting all the way to the day of expiration to get the profit from that theta decay and volatility collapse. But if we do a wider profit zone, we can take profit usually a lot earlier, typically any day. So I'll show you an examples of those. So it's going to give you that wider profit zone. So that's a big benefit, widen out that spread, gives you a bigger profit zone to participate, before option expiration. Again, they're going to be structured for very defined risk, great for hedging. So we can leg in, leg out if we needed to. We use these a lot, what we call these targeted directional swing trades. Really great for, if you're trying to look for what we call penny trades, where you're looking for maybe an expiration that's going to go out a certain strike up or down. We can set our targets based on that. Really great for high volatility markets because we can reduce our cost of the spread, and that's going to reduce our potential, capital that we're putting out at risk. Also great for high price stocks because we can, I'll show you an example here of something like Amazon, when it was trading, over $1,000 a share. It's very expensive to trade the shares, but we could trade it using Butterfly because we can make it a low cost trade. So trade duration, 1 day to 2 weeks out, that's about the sweet spot. The sweet spot's about 5 or 6 or 7 days out. So a little bit more short duration on this type of strategy. Also the great advantage, positive theta, no time decay, and you're going to get returns of 2 to 1 up to 10 to 1, sometimes even higher using this kind of strategy. So a lot of great benefits and flexibility to the Butterfly and Condor. Now here's an example of a wide wing butterfly using a short trade on QQQ. So this was a short trade on QQQ using a wide wing put butterfly. So the spread width was $1,000, so $10 or $1,000 per spread. So a really wide profit zone. So this was one that was set up with the alert service and sent out. So you can see here it just says, a new QQQ short trade. It was trading at that point 314.60. This was what we call a cycle high retracement reversal. So it was the market had gone up on QQQ and it was reversing down. So we were looking for a bigger move down and targeting a certain area here. So we were looking for a move down to target. In this example, it was trading at 314. And we were looking for a potential move all the way down at 304. So that was our target area of the body of the butterfly. So this was done around 210. So this was going long the 26 August 314 put, short 2 of the 304 puts, that was the target, and then long the 294. All right, so that was the trade setup, and that's what it looked like when the alert went out to the alert service members. So now with this trade, you can see your max debit paid was going to be the risk of $210 per spread. Now it was $10 wide spread, so your potential profit on expiration, if you nailed it perfectly, would be $790, which would be then a 376% return. Or your risk, your potential return is $3.76 and you're risking $1, as far as the ratio on that. So here was where it was, 314.60, and then it dropped here and into the target zone at the 26. It was trading right here at about let's see, it's trading at 304, so almost perfect down to that target area. The probability of winning, well, the probability of winning is going to really depend on your directional view. Okay, so a number of things. This isn't like the credit spread. We call credit spreads probability trades. So the probability of winning on these trades, if you want to look at the delta, you can get the probabilities, but the basic comes down to hitting your target areas. So if you're going short here, what we'll do is we'll look at the expected move, and that'll give us our target area to the downside. And then we're just looking for any movement into that target area. It doesn't have to be exact, because if you do, in this example, a wider butterfly, we've reduced our risk. But if we get any kind of movement towards that target area, which in this example was 304, so it doesn't, maybe it just goes to 310, but we're still going to have a profit, but we're going to have it on a very low risk. So the key to the butterfly is your directional view. So if you think it's going to go up, you could do a very wide wing butterfly to the upside. You think it's going to go down, you do a very wide wing butterfly to the downside. But the purpose of the butterfly is to get the trade set up with low risk, but then a very potential high reward, and then play it from there. So with the credit spreads, you're basically selling it, to as a probability trade based on the option delta. So a lot of things to consider, but this is a more in tune with a targeted trade. So in this example, we had it was trading at 314 going in. We were looking for a downside move, and we were targeting down to this Fibonacci level and a lot of option activity. So you can see that's at 382 right there, and it was breaking there. And now it was trading down to around right here was 307.44. So let's take a look here. I'll show you how this one panned out. So we did the targeted trade, and this was, trading here. We were targeting, the big target was 304, and that was based on the expected move down and plus the Fibonacci levels. Now, if you just done the ETF, the QQQ, and you had that move to 304, you would have received $10.60 per share. So in this example, if you did just shorting the shares, you would make 3.36% return on your capital. But with this one, you have potential to make, over 300%. So here's your trade setup. You've got, it was trading right there at 314.60. So we're targeting to 304. So the 314, 304 put spread, and then the 304, 294 part of that spread. So spread with $10, 1,000 less the cost of the trade. This was a debit cost then of $210. So if you nailed it perfectly, that would give you $790 per spread, or a 376% return. So you're risking $1 to make potentially $3.76 versus if you just did the shares, the max would be 3.36% return. So here's the outcome. So you can see here it says max profit 790, max loss, that debit cost that you have there. So here's the wide body butterfly, what it looks like on the profile it was going out. So here it was, we were targeting right here at 304. So did not quite make it there, but that's fine because you've got this wide body potentially for profit. So here it was going out on the 26th, trading at 306.17. And so at that point, went from $2.10 debit. Now it was at $7.82, okay, right there. So this was up $572 per spread. That's a 276% versus if you did the shares, would be 3.6 again. So time decay, volatility crush, low defined risk, and potential for a high return on your capital. So you can see this is what we call the body, and the profit zone here again. You can see, if you go out any of these points, we can use our analytics to tell us exactly what the profit would be inside that profit zone there. So your losses, if it exceeds the outside of your long, or the outside of your long here. So if the wider you make it, the more potential you'll have for collecting the profit, just like using a wide butterfly net. So you can participate with smaller moves, and also at any point in time, basically, if you make it wide enough. So here's an example of using the butterfly for very high price stocks to lower the risk using a wide wing butterfly. So this was on Amazon. Now I like this example because this shows you a couple different things. It shows you that you can, use this structure to trade really high price stocks. When you had Amazon and Google's and all those that were trading at, $1,000 or whatever, it was very hard to trade because, unless you had a huge account. But with the butterfly, you could get into these trades for lowered risk, but still have the same potential upside rewards. So this is one, and also then you're going to see the beauty of the butterfly, because it's going to get a lot of the income comes from that volatility going to zero and time decay going to zero at expiration. So you're going to see the double benefits that you get. So here's one on Amazon. This is back when Amazon was trading over $1,000. So you can see here in this example, it was trading on this, when we set this up, it was trading at 1,782. Okay, so if you bought 100 shares there, you're basically out $178,200, right? Crazy, but that's where it was for a long time. But we're going to be able to do this same trade, controlling, potential for $178,000 worth of shares with the butterfly. So we were looking for a target up to 1830. So it was trading here. This was like the 200-day moving average. It was just kind of grinding, holding there. And then we're looking for a move just to 1830 up here, based on Fibonacci levels and option activity. So that was our target zone. So to do this very, very low risk, but still be able to trade a stock like Amazon, did this using a butterfly. So the target was 1830, and right here. So if you did the shares, when it's trading at 1,720, your potential risk is huge, right? So if it didn't go your direction, that's a lot of money that you're putting out, to capitalize on a move up. But if you did hit it, using the shares, you would have made $48 per share. So your return would be, just in this example, 2.69% return. But what we did was using a butterfly, targeting that 1830. So did a $10 wide spread. So bought the 1820, sold the 1830, sold the 1830, bought the 1840. So targeting that spread there, 1830. All right, so did that a wide body. Now, the cost of this trade, though, was 80 cents or $80 per butterfly spread. And then your potential profit, you can see, would be $1,000 spread width less your cost of the spread. So theoretically, if it hit right there, you can make $920 per spread, but you've got a wide profit zone. So anywhere in there, you're still making a profit on a very low risk versus if you're doing the shares here, you had a huge amount of potential risk and a very small return for that risk. But in this example, you can see it'd be over, if you did nail it right there, this would be 1,150% return, or risking $1 to make $11.50. So that's a couple different benefits, but let's go through it. I'll show you the other really great benefit from this. So here it was, and this is at expiration, on a Friday expiration. So this was in the morning, so the AM. So on the 6th, this was the September 6th was the option expiration. So at that point in time, it was trading right here in the morning at 1836.55. So it was trading at 1,800 $1,836.55. So it actually overshot the target 1830. But even right there, being overshooting this in the morning, this was up $150 per spread. So it went from 80 cents to 230. So in the morning, this was up 150 on that risk of 80. So that's 187% return. That's still a great return, right? I'd be happy with 187% return any day of the week. But what you're seeing here, the other great benefit is the potential still for profit is huge. So this, see all that black area? That's all still potential profit that's left in this trade. That's going to be made up of time value and volatility. And so at the end of the day, if we get to the end of the day, which obviously will, and if it's trading here though, you've got all that potential profit still in the spread. So here it was early in the morning, so it was up 150, but here it is in the afternoon, the same day. You'll see the big, huge difference. So here it is the same day, but now it's trading at 1832. It's coming back closer, but it's at the end of the day. And so now it's stripped out all that time decay that was in it, volatility, and at the end of the day, at expiration, what happens? Time goes to zero, and volatility goes to zero. So that part of the credit spread that we brought in from selling the sell side, that's going right straight to our profit into our pocket. So at this point in time, at the end of the day, now it's trading 1832. And so the spread went from down here from 80 cents. Now it was at 6.95. All right. So that's going to be then a $614 profit, or now you've got a 769% return versus that 269 on the stock. So this double or went actually 4 times. So it was 180 in the morning, now it's 769. So those are some really big benefits. Not only can you trade a high price stock, you can trade a lower cost, as far as your capital at risk, and you can see the benefit that you're getting from the time decay and volatility collapse going into expiration. So, 4 times more at the end of the day. So question, how do you overcome price variance on SPY? I've tried SPX on a daily position to expiry, but are not making you money. Well, that's typical. I mean, you're trying to bet on something for a daily expiration, and over time, you're probably not going to make money, to be honest with you. So, the same day options, they're real popular because they're cheap. But again, it's going to be over time, you're probably not going to make money. So really, in my opinion, for any of these trades, they're really what we call based on kind of swing trades. And occasionally though, if you get the direction right, you can. But what you really need to do, if you're doing like the same day trades, you really need to be, looking at your option activity and looking at your, what I call, your target zones. So if you got good option activity, at a certain strike, and you're doing a butterfly targeting that's the way to do it. But if you're just every day doing in these daily options, it's a hard game. UNG, we can take a look at it. It's still, we'll take a look at it. Still doesn't look good, but we'll take a look. I'll take a look here in a little bit. We'll show you. I'll go through UNG. So I could tell you more and go through some more examples, but that's the main thing. Okay, so here's another question. With the Amazon trade, what if the trade went outside the short strike? All right, so look, okay, so here's your short strike right here. That's why you do a wide wing butterfly, right? So look how far outside the short strike it'd have to go. Right here, this is basically your break even. You can see it's right about here at the end of the day. So that'd be, it would have to go to, in this example, about 1840, 1845. All right, so that shows you what we can use our analytics to see what happens. Now, if it went out and closed outside your profits, outside of your long leg here, so let's say it goes out way out here and gaps out here and never comes back, then your loss would be $80. And it depends on, you know, where you are. Like, so if this was a call butterfly, and so you're short that 1830, long 1840, what you want to do before the expiration is just make sure you close out that credit spread side. The debit spread will expire worthless, and your credit spread side, you just close that out. But your max then loss would be the debit cost there. So if it goes outside your long leg here or outside your long leg there, you're defined with your loss, you know, as to the cost of the trade. Did that answer your question there? Now, the thing you just have to look at is your, you know, you've got basically two spreads together. And so if it's going to go out at expiration and you've got the credit spread side that's outside of that, you just close out the credit spread side before the day of expiration and you're good to go. Now, this is a broken wing butterfly. So there are kind of two inherent problems with the traditional long butterfly spread. So first off, the stock has to close within that range of probability. So we're just talking about that. So if we back up here, and here's your range of profitability is your spread. So you've got your, in this example, your call debit spread side. Here's your range of probability there. And then the other range of probability is here. So what we can do when we do a broken wing butterfly, what we're doing is we can reduce the risk either to the downside or upside by breaking a wing. All right, so in the example I'm going to show you next, we did what we call a broken wing call butterfly. So what we did on that was we broke the wing to the upside. So basically, this would be your call debit spread here, and it's going to be a narrower spread. So we're going to have less the cost of the trade. So if we go long a call here, short a call, closer in, we're going to bring in more premium. And then we're selling another call credit spread here, but we're widening out that spread, and that's going to give us more premium because the long side of it's going to be less because it's further out of the money, right? So conceptually, think about that. So it's going to be less because the long wing is going to be out of the money further out, so it's going to cost us less, so we'll receive more credit. So we can do it either way. So we can break the wing either that way, or we can break the wing the other way. And, if we think there's more potential for it to really run to the upside, then we could do it the other way. So we can make this wider if we think it's going to really rip to the upside, which over the last week or so, if you're doing butterflies on things like, basically hindsight 2020, Amazon, Google, you would want to do a broken wing butterfly, making the call debit spread side real wide and the credit spread short, okay? So I'll show you this example. The next is one that we did using a broken wing butterfly on Google. So how can we fix that probability zone? So here's the way to do it. So this is one that we set up on Microsoft, and we did this with a broken wing butterfly. Now at the point when we were doing this, so this is what the alert looked like going out. You can see it says new Microsoft long monthly penny trade. So at that time on the 11th. So question, no risk of being assigned on the stock. Okay, so assignment risk is going to be based on two things. So if you're doing a credit spread, if you do credit spreads, then if your short strike is in the money at expiration, you're going to be exercised, right? So let's say, let me just back up here a minute. Let me see if I can make this a little bit more clear to you. This is where a lot of people, and rightly so, get worried about assignment risk, but it's nothing to be worried about. All you have to do is just know what makes assignment risk happen. So for example, let's say we have, let's say we've got, we're looking for a move to, let's say $100. Okay, so we're targeting $100 on the upside. And let's say when we're looking at this, maybe it's trading, the mark, whatever we're trading is $50, right? And we're looking for a move to $100. Now, let's say that you did a credit spread and you think $100 is going to be maybe the max that it's going to go. But let's say, so based on that, maybe you did a credit spread further out of the money where you sold maybe the 110 short strike up here, right? So you sold the 110 and then maybe above that you bought the 115. So this is what we call a probability trade. So it's going to be maybe you sold that, you had a delta that was 20. So theoretically, the way we could look at that is that short strike, the 110 had a 20 delta. So that would give us, if you look at the delta of 100 less your delta that you shorted there. So you're going into that trade with an 80% probability that the price will be below 110 at expiration. Now, if you did the credit spread here and it blew through, let's say it just ripped right through your 110, and now it was trading at 115. So now you're in the money, your short strike is $5 in the money and the market's trading here. Now, a couple things can happen. You have to look at your intrinsic, extrinsic value. And if you were to do this, let's say it was a Thursday before expiration on Friday, and it was trading at 115, you need to look at your intrinsic, extrinsic value. And if there's no extrinsic value left, you're going to be assigned. So you come back in, let's say on Thursday, it's trading 115. You come in on Friday, you're going to be assigned and you're now short 100 shares at 110. So all you have to do is just at the end of the day, look at your intrinsic, extrinsic value. And if there's nothing left of your extrinsic value, close it out before the end of the day. All right, so that's a simple answer to it, but there's more, but that's basically what you're looking at. But if you're way out here, let's say you're a week or 2 weeks out and it goes through here, up here, well, just look at your intrinsic, extrinsic value, and if there's a lot of extrinsic value, which is your time, and there's a lot left, you're not going to be exercised because it's going to be more beneficial to that person that was long the 110 short strike that you shorted them. They might as well just sell it to take advantage of the time theta decay that's still in the spread. So it's better for them to sell the option than to take assignment of it. Yeah, and to avoid exercise, you can use SPX, things like that, index options. But as long as you just know that on SPY, whatever, there's no real problem with it. So I'll talk about it more here later, but that's the long and short of it. But the index options those are called European options. So they're cash settled, so there's no assignment risk. So going back through this example, so we did this as a broken wing because we were worried that actually Microsoft had such a big move up. I was more worried that it would have maybe a move down than an explosive move up, which we could see over the last 2 weeks. These AI trades have been just crazy. But this is how we control the risk for potential move back down. So this was doing a broken wing butterfly. So you can see here, I'll just kind of outline it. It says trading around 309.40, looking for a monthly pin move to 315. We're looking for a move to 315. So there's good option open interest there. But to keep the risk low, we use a long call broken wing butterfly. So in this example, what we're doing was we were buying the 310 call short the 315. So this was going to be a $5 wide spread width. And then we sold the 315 and we bought the 322.5. So that was a $7.50 wide credit spread there. And then we took the trade, and this will show you what it was doing on the 19th, which was expiration. So, I'm kind of, trying to save time with everybody, but I'm trying to go through the highlights of these trades. But, there's more detail into it, but I'm trying to highlight the big parts of it and what they were done. So if you look here, so this was a 310, 315, 322.5. And so we structured it more with the broken wing for potential downside if it failed, then an explosive move upside. So we had our downside risk, maximum risk was $85 per spread, and the potential profit if it went out at that 315 was going to be $415 per spread, or a 488% return. So what I was worried about, again, was we were trading right here. See how Microsoft had come up here, and it was just kind of consolidating right here. So we're looking for the next move to this 315 area, which was, you know, a lot of option activity was going on at that level. So when I'm looking at this trade, I was more concerned with this thing faltering and pulling back, you know, to kind of a mean reversion back to this 618 level there. So I was more worried about it pulling back than it exploding up. Now, hindsight 2020, if I knew what I know now, I would have done it the other way around. But this is hedging it for less risk to the downside. So here's a broken wing called butterfly for you know, less risk on the downside. So here's what the trade, if you look at it, so let's just walk through it. So did the 310 long 315. So here's your kind of call debit spread there, right? So this was $5 wide spread width. So this was going to cost less, you know, because we're going to get more. We're long the 310 call and then short the 315. So we're bringing in, it's $5. We're going to bring in more credit at the 315 strike, which will make this debit spread lower. Now, then we wanted to make we wanted to bring in more credit. So we sold the 315, but instead of buying the 15 and buying the 320, we did the 322.5. So we made it instead of buying it at the 320 right there, which would have been a balanced butterfly, we did it like this. So we brought in more credit from this part of the spread because we bought further out of the money that 322.5, which is going to cost less. So we structured the trade here, then it dropped this total risk to 85 on any downside move. Now, there's no free lunch. So if it exploded up and never came back, the upside risk was increased to potentially 335. But we didn't think that was going to happen. I didn't think that was going to happen. It didn't really. So here was the spread, what it looked like, and this was done for 85 cents or $85. And here's where it went out on the 19th, okay? So here it was trading at the end of the day, on the day of expiration, it was trading out. Here was our target, we were targeting 315, but it had overshot that and was trading right here. So this is the beauty of the wider wing butterfly. So this is still a $5 wide spread, and the other part of the spread is 7.5. See that? So this part's 5 and this is 7.5. Now at that point, at that price point there though, this was still up $136 per spread, all right? So it was still 160% return. So still a great trade. Now, if it went out right here, there was potential to make, you know, 455. So that's a broken wing butterfly. So we were adjusting it for protection more if it fell off. We could have done it the other way for a bigger move up to the upside. So that's kind of an example there. Yeah, we'll take a look at the question. Can you give us an analysis of the current S&P? Yeah, we'll do that too. So we'll go through, let's see, at the end of the, we'll go through, I'll go through UNG and I'll give you an update on my view in the S&P as well. All right, so that's a broken wing butterfly, you know, breaking the wing for, you know, potential risk more so to the downside than upside. So question, is it possible to close a trade at the maximum profit? I'll show you in a minute. Yeah. So here's what we call a pinning trade. So this was on Google, and this is a, you know, when we say pinning, we're looking for potential at expiration for whatever the security is to go out at that strike, at a specific strike at expiration. So we call that a pin. So here was a long call butterfly looking for Google to be pinned at a specific strike price. And so this was done with a $400 wide spread width. So with this trade setup, we were looking, Google was trading at 95.75, and we were looking for, based on Fibonacci, option activity, things like that, we were looking for Google to go out at expiration and pin at expiration to be close to this $100 price point there. So we did a butterfly with the body targeting 100, okay? So it was trading at 95.75. We were looking for just kind of the upside target was $100. That would be, then if it went out right at $100, that would be called, or it would pin, the strike would be $100 and pin there. But, you know, with the butterfly, we make it wide enough, we can give ourselves a little, you know, room, wiggle room, so it doesn't have to be exactly at 100. So this actually went out at 101, but still had a decent, really decent profit on the trade. So here was a trade setup. So it was trading at 95.75. So went out and bought the 96 call, sold the 100, sold the 100, bought the 104. So $4 wide butterfly, okay? Cost of the trade then was 80 cents or $80. That was the maximum spread cost, maximum risk. Potential profit then would be 320 if it hit, you know, our target at 100 at expiration. And so that would be a 400% return. So risking $1 to make 4. All right, so risk the 80, potentially 320. But, you know, with the butterfly, we don't have to make it pin exactly. Anywhere in between here, we still make a really great profit. And that's what makes the butterfly great, because we still have a way to participate, but with lower cost. So here it was going out at expiration, and it was trading here on the 17th. It was trading right here at 101.12. Okay, 101.12. So it was right here going out. And at that point, it was up. It went from $80. Now it was at $285. So we had a profit here of $205 or 256% return. Okay, and we still had that potential money in there, but you know, with the butterfly, the way we trade the butterfly is you try to scale out. So let's say you've got, you know, 4 legs or something, and you might have 1 contract per leg or 2 or 10, whatever. So what you want to do on the butterfly is when you start hitting into your profit zone, you take a little off, and what you try to do is save a little bit for the very last day of expiration to see if you can get that exact pin. So it gets a little bit tricky, but what you're doing is just trying to, you know, maximize your profit. Now, if you, but you still, even if you had 1 contract, you might take it off in here and you still got a great return. But if you're trying to really nail it, you want to kind of scale out. So let's look here. Now, somebody was asking, let's see, here was, so here was a question from Daniel. Is it possible to close a trade at maximum profit? So it is. Well, not exactly, but very close. So this is what we call a lotto trade or a lotto ticket. So this is the butterfly, okay? So these are really exciting, pretty fun. So let me go through what this basically is. And so this is a really good, this was from one of my members, Bill. And so this kind of summarizes what we were talking about earlier, you know, hitting singles, doubles, and occasionally you hit the home run. So this was from one of my members, Bill. He said, butterfly strategy is one of my favorites. It's big winners that eventually make the difference in any trading account. So that's so true, right? But we want to control that risk. We don't want to always go, you know, for big winners over and over. That way you're just going to have these wild equity swings. So with all the so-called low risk option strategies being sold to the public, an account without the potential to hit the big one once in a while, so he says once in a while, while not betting the farm, is a slow ride up a long hill. So so what he's saying, we've got a nice, you know, slow equity curve, but it's moving up. So, but this strategy is easy as ABC, and it really is. Once you get the hang of it, they're very easy to put on and very easy to trade. So here's an example of one that we set up this about a week ago. Okay, so this was from the trading room. So this is from Jay. Okay, so this was from trading room talking back and forth in our virtual trading room. So Jay says this is 8:45. This was last Monday. Okay, so he says happy Monday all. Tesla was fun Friday. It's hard to get those perfect pins. And then Gene, one of the other members, says, right after that, 8:48, says, back to Jay, says, yeah, also had a good return on that Tesla butterfly and the Microsoft butterfly last week. So the Microsoft one was the broken wing butterfly I just showed you. Now, then Jay goes on and says, okay, great, Gene. I do a lot of butterflies every month. It's fun, low risk, and Larry has given us the method. So here's the trade that they're talking about. So this was in the trade room, and then they took the trade. A number of the members took it. So this was Tesla, and this was going into monthly expiration. So Tesla on the 15th, right here, that was a Monday, 2 Mondays ago. On the 15th, Tesla was trading right here at 166.50. All right, so it's trading right here, right there. All right, so with this trade though, this is kind of what we call a lotto trade. The trade was set up looking for a move to 180. Now, when it was trading here, let me pull the chart up and I'll show you. So at 180 though, it went out trading on the 19th at 179.99. Okay, so here's what it looked like, and I'll pull the chart up to show you kind of at the point in time what it looked like going in. So the trade was looking for a move to 180 into that Friday expiration, so set up on a Monday. And so here was the trade setup, and this is a lotto trade kind of set up because the risk on this trade is 40 cents. So you can put these trades on literally. This trade, if you did a little bit earlier, this was maybe you could have gotten it in for $30, maybe even 25, or less. So think about it. So if you put the trade on for this small of capital at risk and you lose it, if you lose $25 per spread or 30 or 40, that's not going to kill you, right? Now, if it's 200, 300, 400, 1,000, that's going to hurt. But look at this trade. So put the trade on for 40 cents or $40 max risk. So if you never did anything at all and risking that 40 bucks, but look at the potential profit if you nailed it at expiration at that strike of 180. So this trade had a potential. It's a $5 wide spread. Your cost is 40, so you had a potential to make $460 on that risk of 40. So that's 1,150% return. Okay, so literally you can do. We've done these for as little as $10, $9 sometimes. Okay, but that's a fantastic because it's got a nice wide spread. So here you can see the potential max loss would be 40. If you nailed it perfect, it's 460. But what if it goes out anywhere in between? You still have a great potential return. So this is why it's called a lotto trade. So here it was on the 15th, day of expiration. On the 19th, it was traded at 179.99. So this was up $451 per spread on the risk of 40. So that's 1,128% return over that period. So that was almost perfectly nailed. See the top of the butterfly tent? That's about as close as you're going to ever get. So that's why we call these kind of trades lotto trades. Yeah, so Ned was in that one too. So here's another, so a bunch of the members that set this one up. Yeah, so here's Ned. Thanks for sharing that. So the trade was 30 to 40 cents on that day. And I'll go back and I'll hold on a second. I'll go back and I'll show you that. 1 second. So they're, like I said, they're exciting and they potentially have the big potential upside with very low risk. 1 second here. So that was also from one of the other members. So that's what we call a kind of a lotto trade. Now, let me show you, let me back up and show you what it was looking like on Tesla at that point in time. And there's a certain method to it that, I'll talk about here in a bit on how to analyze and look for these areas where it can potentially go out. So just to show you with Tesla, here it was, I'm just going to back up so you can see kind of what everybody was looking at when we were looking at that trade setup. So here it was, let me put it down to the daily. So this was Monday right here. Let me mark that so you can kind of get an idea what we're looking at. So we were looking at this Monday morning in the trading room. Okay. And so we were looking for potential, see, here's our Fibonacci. So we're looking at the Fibonacci target area and option activity at that area. And so this was just, taking a Fibonacci swing from that high to low. We had the 50% retracement coming in here at 180, and there was a lot of option activity going on there. So we were thinking, okay, every day in the trade room, we'll look at a bunch of different trade ideas and setups. So this was one we were looking at specifically on that Monday. So Tesla was trading down here. You can see it's kind of trading right on its support. All right. And so then we were looking for upside move. The markets were kind of grinding up. So we're looking at, okay, what if we did Tesla and we're targeting this 180? So it was within the expected move. So that's where the trade setup was. And actually at that time, like Ned said, this thing was going for 30 to 40 bucks, So if you'd done it a little earlier, you could have gotten into the trade at 30 cents or $30. So, if you did one spread, you lose 30 bucks. If you did 10, you lose 300. It just depends, whatever. Let's see, BHF, you don't adjust the trade, just let it ride to expiration. Yeah, I mean, on these types of trades, you don't want to make any adjustments. Your risk is your debit paid, so don't, just leave it alone, okay? So you have to go in thinking, okay, if I'm wrong, I'm okay with losing 30 or 40. Now you could adjust it if you want, but sometimes you can just kind of overdo it. So it's better just to leave it alone. So that's the look there, and then you can see it just started grinding. Actually, the next day it was off a little, and then boom, look, there it goes. Now it's at 175, 177, and that's where it was on a Friday, and then look where it is now. We were trying to do this. We were trying to actually set up Friday morning. We tried to put a butterfly on for a move to 200, but it just blew to the upside so fast we missed that one. Okay, so here's another way. This is what hedging trade management. So this is a really great example of using the butterfly condor hedge, or you could do the butterfly hedge. But this is what we talk about, using the flexibility of using a condor hedge. And this is one we hedged into a free trade. So what is a free trade? Let me go through what this is and how it works. And this is the other beauty of these types of spreads. So in this example, QQQ was trading at $365, and we were looking for a move to the downside, okay? So this was a hard move down. So it was trading right here when we set the trade up. So 365, okay? So we were looking for a big move down to about, our target was about down here to this area here at 355. Now it just collapsed, okay? You can see it just collapsed down. So really hard move down. So we had a really big profit in the debit spread side. I'll go through and show you. So we had a big profit there. So what we did, though, you can do this. What's beautiful about it is that when we were down here, we had this big profit. So we then sold way out of the money bull put credit spread and brought in enough credit that offset the actual debit costs from the original trade. Now we had what we call a put condor on, and we had it on for actually a free trade, a credit. Okay, so let me see if I can go through here and walk you through it so you're not, confused. So then the 28th, and then we had made the adjustment right here on the 1st. So it was trading down here at 354. So it just collapsed from 365 to 364. So on this day, the 1st, when it was trading here, we made the adjustment, which I'll show you in a minute. And then at expiration, 5 days later, this was a profit, max profit at 359.67. So right here, close the trade out, and it was on zero risk. So this is the other cool thing you can do with these trades once you understand how they work. So here was the trade going in for the adjustment. So trade 1 was on the 28th. So did the 364, 360 put debit spread. Total cost on that spread was $121. Nice risk, not bad. $4 wide spread, potential to make $279, 230% return. Nice trade. So here was that trade set up there, long a put, short a put. If it went out here, you make that max profit. But what tends to happen, the markets hit hard down, and then a lot of times they'll jerk back up. So you miss your max profit, but then maybe they keep going down. So this is a way you can play more downside, but if you get it right, you can do it on zero risk or very little risk. So then trade 2, we'll call it trade 2, so you can kind of follow. That was on the 1st. Now it's trading at 354. So what we did, you take some profit, and then we adjusted the balance of the trade by selling a bull put credit spread at 354, 350. We were able to bring in $141 credit. All right, then look what happened. So the initial trade, that 364.60, we had a $1.21 debit. When it ripped to the downside, we sold that other spread against it, brought in 141. So that offset that debit cost, actually gave us a credit of $20. So now we're in a free trade, zero risk. And if it went straight to the downside or straight to the upside, never recovered, we still make $20. Now this went out perfect. It went out trading right here at 359.67. And so this was actually a max profit within that big profit zone there. So this is went from a credit of $20, and then at expiration, you just sit back and let it do its thing and then close the trade out. So now it was trading here on the 7th at 359.67 right there. So we had our max profit. So we had the profit zone here, the put spread, the original put debit spread, and the bull put credit spread. So it was up here. So this expired worthless. This was max profit in there. And so we made, this was $420 profit. So you can see if you just look down below, you can see what happened with the two different spreads here. Let me see if I can walk you through. So the put debit spread, we brought in $1.21. This went out pretty much max profit. So $400 less 121. So there was your profit on that one. And then the credit spread, we sold at 141. That was right here. And this expired worthless, so we kept 141. So we had that profit of, so what is that? Let me just calculate that real quick. I should have done that. So made 400 less the 121. So made 279 on the original spread. And then we made 141 on that credit spread. And so that was the max profit there of $420 on zero risk. Zero risk is possible because just, okay, walk through this, look at the math. Okay, so the zero risk. So we had the original spread was here. We had long the 364, short the 360. Okay, so that would be your put debit spread side. Okay, so this cost $1.21, $121 for this spread here, right? So $4 wide spread cost 121. Now, when it ripped down, we sold the 350, short the 350, long the, short the 354, excuse me, long the 350. So now we had the bull put credit spread $4 wide, but we brought in, look, $141. So we actually brought in more credit than we had on the debit spread. All right, so we had then 0 risk per spread, long Condor, $20 credit, max potential profit, 420 if it goes out here. Now, if it goes out in here, you still have a fantastic profit. So we got $152 plus the 20. That would be $172 on 0 risk. And that was on the 1st. And then on the 7th, it was trading right here. So it was max profit. So see how that works? All right, so that's the beauty of things you can do there if you just understand the verticals. So the original spread entry 364.60, debit cost 121, then made that adjustment on the 1st, brought in, made this $20 credit. So max potential profit 420. So if you'd like to learn more about how to master these high reward, low risk option strategies that work in any market environment, I'm going to be doing a really exciting, fun course on this next Saturday. Now we'll go through everything else that we were talking about here, some UNG and SPY, but let me go through this for you. Question, are butterflies best for sideways markets? Okay, well, I'll talk about that in a second. Let me just give you the link here. So if you'd like to join us, this is going to be a really fantastic course. And I'll show you everything that's in it. So this will be starting next Saturday, June the 3rd, 11 a.m. to 2 p.m. Eastern. Everything will be recorded if you can't make it or miss part of it. And then we'll finish up with part 2 on Tuesday, the 6th, 4 to 6 p.m. or however long it takes. So here's I've got 2 packages. One is just the course package with all the bonuses and all the good stuff there. And then if you wanted to add the alert service to it, I've got that as well. So use that link there, and you should be able to just click on that. And let's see, hope that should work for you. Let me see. Click on that. That'll pull up the payment link here, and you'll see this will be $197. I'll go through all the bonuses and stuff with you here in a second. Then we'll take questions, look at the market, whatever. So $197. Now, if you want to add my indicators, you've got the opportunity to do that as well. You can add those for $195, but the core course is $197. And so use that link there. And let's go through the bonuses and everything, and then I'll take questions and we'll go through trade examples or market examples, etc. So with this course package, you get all these nice bonuses that come with it. So first off, though, access to the live course next Saturday, starting next Saturday. So, value there, $1,500. Then you're going to get my Fibonacci price mapping course. This is what we use to give us those targets to the upside or downside, to set the butterflies for the targets. So you'll get that as a bonus. Now, if you go to my website, you'll see the price there would be $397. So that's a bonus course there. And then you're going to get, to add to your trading library, start trading options today. This is a kind of an intermediate option course. And so that would be $197 on my site. Then as an extra bonus for support for everybody, you're going to get, if you do this package, you get a 30-day trial membership to my trading club. So this is where we, every day we go through all different types of trades, whatever. So this is where, that Tesla trade came out of, being in the trading club virtual trading room that Monday morning. So that's $97 a month. Now you'll get 30-day trial membership for $0 if you decide to stay in. Hopefully you will. It's $97 a month. And you can start this whenever you want. You don't have to start it right away. If you want to wait till the course, then start it, let us know. Then we'll do a follow-up live Q&A, for the course. Then you're going to get my option trading tutorial, just another kind of option course on the Greeks. And then you're going to get my option strategy manifestos, 15 other different option strategies that you can look at. It shows you how they work. So, really great value here, total over $2,600, $197. This course is yours forever. And then we'll do everything will be recorded, broken down in modules of 30 minutes or less, full trading manual, the PowerPoint and any handouts. So use that link, powercycletrading.com/butterfly, and that's the course package 1 with everything. Oh, thanks, Ned. Here's some nice feedback from Ned. Ned was one of the guys that took that Tesla trade for a nice return. Hold on. Thanks, Ned. Well, it didn't cop. Hold on. I'm having trouble with this thing. There we go. Thanks, Ned. Here, let me give you the link again, Barbara. Hold on. So here's the link for course package 1. Okay, so that's everything there. And then we'll go through the bonuses and take questions. But here's, if you want the alert service added to it, this is what you're going to get here. So this is what I call my Elite Open and Close Alert Service Package 2. And this one will give you everything in package 1, but also comes with 4 months of my trading alerts and 4 months of the trading club added to it. 1 second here. Wrong link. Let me get this link. This copy and paste is not working as well. Hold on. So use this link if you want the alert service added to it. And there is a to-pay if you prefer that. So use this link here. Let me double check it. So it's basically powercycletrading.com/BF alert. And double check this one. And yeah, it's $5.97. Okay, so you get everything in course package 1, but you'll get the alerts for 4 months and 4 months of the trading club. And there's also to-pay if you'd prefer that. Okay, so that's the alert service added to it. So with this one, I have 4 different alerts that I send out. This will be top butterfly and long condor trade setups that are sent out. Other ones that we do a whole lot of are counter diagonal setups, breakout reversals, and these might be credit spreads as well, and then specific earnings trades. So 4 different types of trades that are sent out through the alert service. And you can stop and start this whenever, over the next 4 months. If you go on vacation, you want to stop it for a week or 2 weeks, you can, and then, start back. So with this, you'll get the 4 months of the alerts plus 4 months of the trading club. The trading club is, I'll show you the benefits, and that's where you get the access to the virtual trading room. So with this, 4 months of both of those, plus everything in course package 1, all bonuses. So typically we'll do 10, 15 stocks or ETFs per month. Do a lot of ETF trades, because they're nice and liquid and easy to get in, easy to get out. So either selective butterflies or condors, selective counter diagonals, breakout reversals, could be debit spreads, credit spreads, and then earnings trade setups. So when I send these out, you'll get a specific trading guide. A lot of members just do their own thing. They just want the trades. They don't have time to go through the markets all day long, looking for trades. So I do that for you. So they may just do their own thing. But whenever I send out a trade alert, I always give you a guide with an option strategy to use. So a guide for that, trade setup videos. So if we do alert trade, do a video update on these. How do you close a butterfly? Question on that. Depends on where it is. If it's nothing is in the money on the trade, you can just let it close out by itself. If you have a part of the spread, let's say if the credit spread side is in the money, you've got the credit spread side in the money. That's the only thing you need to be aware of. You just close that out before the close of the day. And the debit spread most of the time will just, depends on where it is, you can let it just auto close out by itself. So it varies. But if you take the course, we'll go through exactly how you do it, but that's kind of a quick summary of it. So I would, of course, I'm going to say it, but I would definitely say take the course. If you have any of these questions about exercise, auto exercise, things like that, take the course and we'll go through that. You'll be very comfortable with it. For $197, it'll be the best price for $197 that you pay. So then I do a video update showing you the trade setup, why it was done. We do a weekly Q&A, so you'll have access to that live and recorded every week for the next 4 months. We typically do that every Tuesday. And then I do a video newsletter at the end of the day, just showing you the market, when I look at the market, my kind of take on the market, whatever trades we're looking at, things like that. So you'll get that for the next 4 months. That comes out every day after the close. What broker recommended? Well, there's a bunch of good ones, you know, Tasty Trade, Thinkorswim, TradeStation. Those are a couple that you can look at. So with the trial, do I get the alerts? No. The trading club is separate from the alerts. Okay, the trading club is, we'll go through that in a second. The alerts I send out by text. Okay, so and there's a lot of work that is done. Now, if you come in the trading room, a lot of the trades that I do send out by the alerts, a lot of times we'll cover those in the trading room. So, you know, those are trade setups that, you know, we always look at in the trade room, but then I send them out by the alert, could be later in the day. And then I'll give you just updates on those trades throughout the day. So we use a system called Telegram. I'll show you what that looks like. So here's if I can get this up. So here's what we use, and this is I'll show you this in a minute, this trade. So we use this. So for example, on Friday, we did this actually long call Condor on Amazon. So this is what it looked like. This was the trade setup on Friday. And so we knew Amazon long trade. It was trading at 118.40. So we did a long call Condor, and we went out, we bought the 118, 120, then sold against the 123, 125. We did this for $66 of risk. Okay, so we did that on Friday. Here's one that we had on the 25th. We did a long trade on MRO, did an adjustment. So, you know, go through there. So these are sent out, these come out within seconds. But this is separate from just the trading club. But with the alert service package, if you do this, you get the trading club plus the alerts, okay? And then access the virtual trading room, open every day during the week, and discounts of 60% off on all trading software, courses, etc. That I have. So for example, here as a member, and if you just do the trial membership, even if you do the 30-day package for the next 30 days, you can get anything that I have listed for sale in my trading club. You can get for 60% off. If I can find this, hold on. Let me pull that up. Sorry for the delay here. One second here. So as that additional benefit, I just want to show you what you can look at if you want to check out courses and things on my website. Just go to the website here, powercycletrading.com, and any courses that I have or software, you'll get 60% off discounts off the price. So my scanner, for example, you wanted to buy that, you know, you'll get that for, it's $397, but you'll get 60% off that. If you want my custom, now these are for sale, upsell for $195, but if you bought it from the site here, you know, you get discounts of 60% off. And then any of my courses, for example, I've got all my trading courses are pretty much geared towards options. Here's that get started option trading. This is a bonus that you get. I just completed this course. So any of this, but here's the butterfly course currently. Right here, the last time I did that was back here in January. So we're going to be updating that. But if you were to go in here and want to buy that currently, that's going for $397. You get that for a discount of 60 off. But here today, you're getting that for $197 plus all the bonuses. So the alert service, just kind of a summary. of all four together, cumulative summary. This is unaudited, but this is what we've done. I started the first part of the service back in 2018, and since we now we have butterflies, calendars, things like that, earnings. But we've had 610 trades closed, 455 winners, 36 break-evens, 119 losers. So overall winning percentage 80, high winning percentage on these trades. So that's the overall summary. And then on the butterfly side, started this back in May of 2019, and we've had unaudited. We've had through Friday, we've had 127 trades closed, 95 winners, 6 break-evens, 26 loser. Very selective trades that I put out, so 80% win rate there. Now these are very low risk. Typically, we use stop loss levels too. So, on average, maybe the average loss might be 75 bucks per spread, something like that. But then you get this potentially big, risk reward ratios of 2 to 1, 4 to 1. You see on that Tesla trade, it was over 1,000%. So you have that upside potential there for these types of trades on the butterfly side. So here's some of what we're going to cover in the course. So we're going to go, I always like to start with the Greek so you understand exactly what's going to happen. Okay, hey Royce, I will join soon from Australia as I'm currently traveling to Vietnam. Hey, great, have a great trip to Vietnam and make sure to join us. Which is the app used for profit loss drawing? I was using Thinkorswim. I like to use Thinkorswim for the analytics. So that's the one I'm using for today's Thinkorswim. So with the course, it's a very extensive course, but we're going to be gearing this course to butterflies. We're going to go through the option Greeks that are vital for the butterfly long condor, so you understand how those work, theta decay, how that impacts the butterfly condor, volatility, the importance, and how that impacts these two spreads. Then pricing the option, very important that you understand option pricing. So the first part of the course, we're going to go through all the Greeks and understand the effects that they have on these two types of strategies. And then we're going to cover in the course, and you get this also as a bonus, Fibonacci. So my price target mapping, standard deviation, how that works to help you give your targets upside or downside for your targeting for your body of your butterflies. So this is really important for selecting the directional price targets. So we had a couple of questions earlier, about the butterfly. And the big thing is you want to establish the targets for your butterfly, and then typically we'll set the butterfly body at those targets. So this is a process used, and this is also a bonus course to you, which I call my option price target mapping or target mapping. And then part two, we get into the really nitty-gritty details of all the different variations. So what really makes them work. So we're going to go through how, why, and when every different strategy works with examples of each one. So how the long call or put butterfly works with examples, the wide wing butterfly, broken wing butterfly examples, go through the structure, exactly how it works, when to use it, why to use it, and then the ratio butterfly, when to use, how to use, broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor. So a lot of variations. We'll go through each and every one. So there may be certain ones that you like, others you don't, but you're going to have knowledge of every one, and then when, how, and why to use it. So then you can pull out the one that the best suits you and your trading goals and what you like. So we'll go through each and every one, the variations, so then you'll know and you can use which one you like. So then we'll go through what are the best time frames to use to capitalize on the butterfly condor. So do you go out 1 day, 2 days, 3 weeks? What stocks, ETFs, index, and futures? You can do these on futures. You can do on index options, whatever. How do you profit from volatility collapse? What is that? How does that work? How do you profit from it? So how do you get those structured setups where you get the 10 to 1 or higher with as little as 10 bucks? And then this is the lotto trade basically. And these are a lot of fun. How to trade the monthly option expiration. So again, this comes out, monthly expiration 12 times a year. And this is what we call option pinning. So this alone is worth $197. So think about it this way. if you did that Tesla trade for 30 or 40 bucks, you pretty much covered the, and if you did one option contract, you covered this course and more, right? So these are really, really fantastic things to understand. And so part of this is going to be based on what we call pinning. And this is going to be based on price target analysis, option activity, and Fibonacci. And this comes into that bonus course that you get with this course here today. So really great bonus there alone. Then we're going to go through the long condor. So this is another really great one because it widens out that profit zone. And this is a really great one that we start out for hedging. Very low capital, positive risk ratio to it. How, why, and when would you use a long condor in your directional trading? And for hedging, typically I'll go with the long condor first hedge. And then part 3 is going to be dedicated to hedging. Okay, and so we're going to spend a lot of time on what I call, we'll go through the progression of hedging, and then we're going to go through how to use the butterfly long condor to hedge a core position, but then I'm going to go through and show you the butterfly defense for defending a vertical debit spread and credit spread. So if you've been doing credit spreads and getting blown apart, you're going to learn the butterfly defense in the course. Okay, so really good defense. And then we'll go through step-by-step checklist, when and how to put the butterfly condor on, when to take them off. A lot of questions today about exercise, expiration risk, things like that. And those are good questions in the course. You'll be totally clear and everything will be clarified to you just on that. So that alone is worth, in my opinion, the price of the course. And then we're going to go through execution adjustments, how to make these adjustments to free trades, things like that. And then a resource library, which will come down to the exchange traded funds, then option, assignment risk, expiration risk, auto exercise. So you're going to get all that covered, how you can, alleviate knowing if you're going to get exercise. So we're going to teach you a couple things to look at, what we call intrinsic, extrinsic value analysis, and that way you can see if you're, in a position where you might get exercised. So once you do the course, you won't have any insecurities about being exercised, okay? And then you get a trading library of 58-page library of different butterflies and condors. So put it this way, we never get exercised because, I'll teach you what to look for and how to make sure you don't. So assignment risk on butterfly, there is assignment risk, but this course will teach you what you need to know. And so you'll never, 99% of the time, never have to worry about it. Okay, after you take this course, you will know there's no big deal to assignment risk, no worries, okay? So here's a little feedback from Richard Leary. You are the only one I know that provides competent, realistic instruction on how to have a Houdini escape hatch plan to utilize the various types of option trades that go against you. It allows a trader to calmly, this is what you're going to learn in the course, use your head to make appropriate trade adjustments instead of wildly panicking and having their head handed to them. I greatly appreciate you sharing your hard-earned profitable trading knowledge and technique. That's from one of my members, Richard. And so here's your bonus bonanza package, and then we'll take more questions. So this is a really great course that you get as a bonus. This is my Fibonacci price target mapping course. Just updated this this past April. So this is an on-demand course that takes you through what I call price target mapping, which maps out price targets up or down and defense targets that you need to set up for your trades. And so it uses Fibonacci, price target analysis, moving averages, what I call price action support resistance, standard deviation, price forecasting, and option activity. So it's a combination of all of this creates what I call target mapping. So it's a 3-hour plus course with your course manual and videos. So really great bonus, but we'll cover this also, a big part of this in the course that we do on the butterfly. Then you're going to get my Start Trading Options course. This is kind of a intermediate beginner's option course that takes you through just the basics, the benefits of options versus stocks, things you need to know about options, how option expiration works, puts and calls, and then I take you through three different actually strategies: the covered calls, covered protected put, and the debit spread strategy are covered in this course. And then you're going to get my Power Cycle Trading Club. So you'll get a 30-day trial membership to course package 1, and you can start it whenever you want. So now this is where you get the trading room. And so in the trading room, this is where we, every day from Monday through Friday, 9:30 to 10:30 Eastern, the room is open. So if you come in, we look at, we'll look at, 10, 12 trade, whatever you want to look at. But we're always, every day we go through looking for trade setup and ideas. And this is where a lot of the potential ideas come from, butterflies, calendars, whatever, credit spreads, whatever. And then members can take these trades or not take them. They get the idea. And then a lot of these trades are sent out to the alert member service as well. So this is the virtual trading club. So with the course package 1, you get this for 30 days as a trial. Now, if you do the alert service package, you'll get this for the next 4 months. So then I do a daily video market update, to tell you about the markets, what we're doing. We do trades are archived. Then we do a virtual weekly Q&A, is live and recorded. We have a nice educational bulk free educational material, and then 6% discounts on all trade software, etc. So this is a really good one. This was from Jay, one of my members. Said, just wanted to say my option knowledge has leaped exponentially since joining your trading room. And this is so true. He said, reading books is fine, but seeing the actual option trade setups make a huge difference. Thanks, Jay. And that's a really good testament to that. And actually, that's Jay that took the Tesla that was talking about, hey, this Tesla trade was really cool. So that was actually from Jay. And then you'll get live follow-up Q&A. We'll do that the day after. This will be also recorded. And then you've got the trading club trading room. So that's for your additional support. One other option course here. Basically, this is a really great course to clarify the option Greek. So this is you'll get the 60-page trading guide and videos on the Greeks, delta gamma, option pricing, what we call market maker secret, how standard deviation works, option delta, trade probabilities. So this whole package is geared for everything you need to know about options. Okay, and that's what I really love. And then one last bonus, what I call my 15 strategy guide. So this is really good. If you're wondering about other things, like if you heard what's a back ratio spread, or what's a short strangle, long strangle, things like that. So just an additional bonus course, bonus package there, the trade construction, when to use on these 15 other types of strategies. So it's a really thorough, course with a lot of great bonuses. And here's just a couple examples of the alert service that you'll, get with it. Here's from Wally, just a nice testimonial. Larry, I have to mention one thing. I am subscribed to a lot of services who send out trades. Some are good, others are not that great. But one thing I'd like people to know in the webinar to know is that when you get a trade alert from Larry, I do it blindly as time has shown me. This man is accurate in his recommendations. And I'll show you the one we just did Friday on Amazon. Thank you, Wally. Wally's actually in Kuwait. And this is another one that I just got from Dan. He said, you're very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades. This is typical. I took with you. He was just trying to learn how to trade options. So that's the other great thing. I really go through a very detailed description of how to do the trade. And so that's how he was doing it, and he paid for his alert service. So again, here's our 80% winning rate overall. And then here's exactly what you're going to get. I'll go through a couple other examples of ones we just recently did. So you'll get this for 4 months. You can stop and start whenever you want. 10 to 15 stocks, always stocks or ETFs. Selected butterfly, long condors alerts sent out. So these are all going to be based on what I think the best strategy would be based on the market condition at the time. So it might be I send out a butterfly, a long condor. So Friday we did a long condor on Amazon, or it might be a counter diagonal. The week earlier in the week we did a counter diagonal on the ETF IYR. I'll show you that in a minute. Could be a breakout reversal debit spread or credit spread or an earnings trade. So it just depends on what's going on. There's a lot going on, right? So then when these are sent out, you get a specific trading guide for each. setup review video, access for 4 months to the Q&As, newsletter, video newsletter, the virtual trading room, discounts on all courses. So it's a lot of great information. It's basically, if you break it down, I think it's like $3.40 a day. So with the option, when I send that alert, like I said earlier, a lot of members just do it to get the trade set up and they do their own thing. But when I send out an alert, you'll get the trade entry, you'll get the suggested option trade, profit targets, what those are based on, what option series to use, stop loss guidelines, and then you'll have these adjustments if needed and updates during the day if something needed to be done. So you'll get that throughout the day. So you don't have to stare at your screen, you'll just get an alert. So do the trade setup video of those trades once we're done. You get access to the video newsletter every day, all this for the next 4 months, access to the trading room and the Q&As for the next 4 months, and discounts on everything 60% off. So it's a lot of great stuff. Now here's a couple alert examples. One I just showed you, this was the butterfly summary, 80% since we've been doing this back in May of 2019. Here's the one I showed you earlier, so we'll just go through that and then I'll take your questions. This was the broken wing butterfly on Microsoft. So we were looking for this upside move to 315, and this went out, right here, trading at about 317.79. So this was up 136, 160% return. Here's another one that we did on butterfly just recently on Microsoft. This was a long call butterfly. It was traded at 280, and we were looking for an upside move on this one as well. This one was set up for $73 per spread risk, and on the expiration, the max potential profit was 427 or 585. Now you can see here in the alert, these are very descriptive. Here it says new Microsoft long, trading at 284, looking for a breakout over 283. Upside target, first target 290, target 295. To keep risk low, we'll use a long call butterfly. So basically, it goes through, this is what's actually the Thinkorswim, how it puts it out. But then I will usually do a summary. So this was then long the 285 call, short 2 of the 290, and then long the 295. So at around 75 cents or $75. And then these are some of the alert updates. I'll send out adjustments up if needed. So that's what that looks like. And here's the trade going out. So we were looking, it was right here. We're looking for an upside move to 290. And so the profit was on the 31st. This was set up on the 29th. 1 day later, the trade was being taken off and it was trading at 287. So these could be 1 day trades. Okay, so out on the 31st and out on the 6th. So here's what it looked like, the profile of the trade. You can see on this one, we set this one up targeting that 290. So it did the 285.90, 95, max risk 73. So here's potential profit 427, max risk there, and 73 costs on the trade. I'm just trying to kind of get through this so we can go through some other stuff. And here it was on the first profit. A lot of times they'll send out, okay, take partial profit. So here's on the 31st. It was traded at 287.62. It was up $64. So here's the beauty of the butterfly. So this was up $64 on this day. The next, 2 days later, right? And so that's an 87% return. Your risk is 73. You make 64. There you go, 87% return on super low risk. So that's why you scale out. And then here it was a few days later going into expiration, and you had a really big pop. And now the trade was trading here on the 6th at 291.76. It was up $251, 343% return. Okay, so right there. So it could have been even better, but it had a big profit zone. So this was up $251. So it went from 73 to 324. So that's a look there. Now, here are a couple other ones. These are the counter diagonals. We do a lot of these, and these are specific for certain market conditions that we like to do. And this one started back in June of 2019. we've done, we do a lot of these because they're just a different kind of trade. But we've done 211 close, 160 winners, 10 break even, 41 losers, 81% reliability. These are unaudited, but this is the trade summary. And I'll go through a couple that we just concluded or did recently to show you an idea of those. So these are some that you'll get as well. So here's one that we just did on IYR. This was a killer. So we've been in and out of IYR. This has been a good one. So this one we set up on the 15th, and it was trading at 84.10. This is an ETF. So basically, we went long the 2 June 84 put, short the 19 May 82. So it's kind of like a put debit spread. So potential risk on it starting out was 115. Now we did some adjustments, et cetera, et cetera. So on the 19th, then we adjusted it to being long still that 2 June 84, but then we adjusted it, took profit on the 82 put, and then sold against the 26 May 81 put. Now we reduced our risk to 95 with a wider spread. And then I'll show you how this worked out. So here it says new IYR short, daily cycle reversal, volatility squeeze with momentum, 513 cross to the downside, looking for a downside target move to 82. So here it is, buy the 2 June 84, sell the 19 May 82, and do this for, we would try to do it around $1.15 to get into it. And then here it was on the 24th. And this was just recently. So IYR short trading at 80.70. Fill, we were looking for a gap fill to 80.76 to take profit, fill the gap, take profit, close trade balance up $165 per spread, 174% return. We're going to look to reset this one probably next week. And so here's what this one looked like going out. This one we just, like I said, set up. So here was right there on the 15th. This was, back on the 15th on a Monday. Set this up, the short trade, and then here we took it off last week on Thursday, the 24th here. Really ripped to the downside, perfect trade setup. And this is what it went out looking like. So the spread went from cost of trade to 95, so it went to 260, less our spread cost. So we were up $165, 174% return using that. So that was a really pretty trade there. Here's one more example, then we'll get into your questions and whatever else you'd like to know that I can answer. Here's one more we did just recently. This was in Google, a long call calendar diagonal. And this one I'll just go through kind of quickly. So new Google long trading at 107.60 in a daily volatility squeeze, breaking above the 618 retracement. So we went long a Google calendar, call calendar diagonal around 215. So long the 19 May 108, short the 5 May 110. So went into that, took it off here on the 11th. And here's what that trade looked like. This was a pretty good one, but overshot. Look at that, just kept going. But here it was on the 11th. So let's see. Yeah, on the 11th, it was trading right here at 116.78. So it went from 234 to 420. So we're up $186 here. Need to, this should be, this I need to change that date. I don't know why I've got that. That should be a different date. So that's where we are. Those are some examples there. And so how many trades will be in 4 months? Well, try to look for, like I said, 10 to 15 stocks or ETFs per month, typically. But a lot of these trades, we do adjustments. So for example, we maybe start some trade out as a calendar. We may adjust it to a condor or debit spread. So a lot of these trades you may stay in for a while of doing different adjustments. So good question though. So that's the kind of rough estimate. So here's package one again. And let me put that in for you. And then one second here. here's course package 1. If I can get this to copy, it's be a little bit difficult. Well, there you go. So link on that, course package 1, powercycletrading.com/BF. And then if you want it with the alert service, here's that link. And then we'll go through, we'll look at UNG, SPY, anything else anybody wants to look at. I'm open for anything that you want to look at. So there are the 2 links there. Yeah, we'll take a look at UNG next. And question from Moaha, is there anything new? Now, these courses, the last time I did this was in January, but every time I do a course, the basic foundation structures are the same, but there's always different things that I come up with as far as the different trade ideas, different, we'll put it that way, different examples. So every course is different based on the current market environment. So it could be more call-based, put-based, things like that. So now if you've taken the course in the past, recently, then you can join us for a retake for a different, adjusted price. Do you have during courses trade? Yes, for sure. Yeah. So if there's a good trade setup that looks good during the course, we'll go through that trade, and it could be one that you do, along with the course. So that way you can help pay for the course pretty quick. Let me show you the Amazon trade. I'll show you that which we'll see if that, hopefully that will work out. Let me pull that one up. And I'll show you, this is a long call condor. So let me just kind of walk you through the trade. Now, I wasn't expecting it to explode like it did, but I'll show you how this trade is set up. So this is one that we just did Friday. Okay, so like, for example, with the alert, with the trading room, so it's open from 8:30 in the morning Central for an hour. So what we typically do is every day we come in, if anybody has a question on a trade, they need help with a trade, or they have a trade they like, and they just kind of want to have my take on it, I'll look at that. But we're always looking for trades, okay? So that's the purpose of the trade room, is looking for trades that the members can take. So we looked through about 10 or 5 or 10 trades on Friday. Looked at the first one we looked at, it was here's the first one we looked at, but then it started taking off so fast, was Tesla on Friday. We were going to go long Tesla. Okay, so we were looking at this. We had a butterfly that we were going to look at, and we had it looked really good. The price looked, we could have gotten into it for $90 per spread. Okay, but then Tesla just right here broke that prior high and then just started ripping. So we said, okay, I'm not going to chase it. So we looked, Tesla's one we looked at first, and then looked at, some others. We looked at Google, et cetera, but then came up with Amazon, and wanted to, wasn't expecting the market to rip like it did. So we were looking at Amazon. We wanted to keep it, it had a big move to the upside. So we wanted a low risk trade. So what we did was we started this trade out. Let me just kind of back up so you get kind of a feel for it. So it was trading right about, look at that, man. So we were looking at this first thing in the morning. So let me put this to the smaller time frame. Look at that, man. So we were looking right on the open. We were looking at this. Okay, so we were looking at this, and it was trading right about here, 116.87. Okay, so what we did was not expecting to have that big of a rip. So we wanted a low risk trade. Thought it was going to move higher. Let me get this to where actually you can kind of see it, what it was looking like in real time. So here it was right here. So here it was first thing in the morning. It was trading right about there. So we set up a long call condor. So let me show you the trade. So what this was now these prices are wrong because the market's closed. This actually went out with a small profit. So what we did was to make this a kind of a low risk trade. In the perfect hindsight 2020, there's always hindsight 2020. If it had more time, I would have just sent this out as a call debit spread, and then we would have adjusted it. But just the markets were starting to move, so just sent this out as a long condor. So you can see the risk on this trade, though, was maximum risk is $65. Okay, try to keep the risk low. Positive theta, $2. So going into a long weekend, we wanted a positive theta trade. So in case it did churn sideways or even come down, we would make money on theta. Wasn't expected to have a big rip, but it's still going to be, looks like it'll be a nice profitable trade. So here's the beauty of it is that if we get a move here, see this is your profit zone right there. So we've got this, basically we're long this call here at the 118, and then we're short that call there at the 120. Okay, and then we sold the 123 right there and bought the 125. Okay, so two kind of spreads, so we can leg in, leg out. But it currently went up right here. So this was up on Friday. This is wrong. It was up about $15. Now, when we come in Monday or Tuesday, when and it's trading right here, this will be up about $35. Okay, so $35. If we decided that we want to take it off then, and our risk is 65, this will be up $30 to $35. You know, so that's about 50% return. So that's a pretty decent return just over a few days. Now on next Friday, though, if this was to go out perfectly between these spreads, this trade will be up $135 on your risk of 65. So that's the reason it was done, to keep that risk low, on that trade. So that was a look there. All right, so let's take a look at a couple others.